So you might have heard of something called integrated reporting. This concept was introduced by the International Integrated Reporting Council in 2010. The world was recovering from the financial crisis at the time, and the members of the IIRC had a vision for a new type of reporting. Their goal was for companies to issue a periodic report that shows how companies use different resources or capitals to create value, not just in the short run, but also in the long run. This integrated reporting was intended to reduce the focus on short-term profits that had contributed to the financial crisis. Now, the IIRC later merged with the Sustainability Accounting Standards Board into the Value Reporting Foundation, which was then consolidated into the International Sustainability Standards Board. But the concept of integrated reporting is still around. So what is integrated reporting? The IIRC defined it as a process founded on integrated thinking that results in a periodic integrated report by an organization that shows how it creates value over time. There are two key components there. The company engages in integrated thinking, and the company issues an integrated report. Let's start with integrated thinking. Integrated thinking is when a company considers the relationship between its business model and the different types of resources it uses to create value over the short, medium, and long term. For example, let's say a company is trying to decide what to do with wastewater from its manufacturing process. In the short run, the cheapest solution might be to just dump the wastewater in a local river. But this could ruin the water supply and damage the company's relationships with the local community and with its customers. People might protest the company, harming its reputation, and the government might impose new regulations. If the company were to engage in integrated thinking, however, the company might invest in a process for recycling the wastewater. Thus, integrated thinking is about considering the company's actions holistically and understanding the different trade-offs of the company's actions. The company is part of a greater system, which is affected by the available resources and by relationships with stakeholders. Thus, integrated reporting is a type of systems thinking, and it results in the issuance of an integrated report. Accounting financial statements provide a limited view of the company's health and value creation process. Integrated reporting, on the other hand, shows not just the financial results of the company, but the company's impact on its stakeholders and on the environment. Thus, an integrated report includes both financial accounting disclosures and sustainability disclosures. And it shows how a company's strategy, governance, and key performance indicators lead to value creation in the long run. Now, an integrated report should be prepared according to the international framework. This framework, which was revised in January of 2021, lays out the rules for creating an integrated report. These rules include the fundamental concepts, guiding principles, and content elements to be used in an integrated report. Thus, you could view the international framework as a guide for creating an integrated report. If you'd like to download the international framework, I'll put a link in the description section below. Now, the international framework identifies 6 types of capital or resources that companies draw on to create value. The 6 capitals are financial capital, such as funds raised from investors or the company's reinvested profits, manufactured capital, which includes things like factories and equipment, intellectual capital, which results from employees generating intangible assets, human capital, which includes the skills and capabilities of people, social and relationship capital, which is based on the relationship between the company and the community in which it operates, and natural capital, which includes water, trees, and minerals. A company's required regulatory filings focus just on financial and manufactured capital. But integrated thinking says that society is best served when organizations consider all 6 types of capital, not just financial and manufactured capital. The value creation process is complicated. A company might create value from the perspective of financial accounting in the short term, but destroy natural capital in the long term. An example would be overfishing, which might increase profit in the short run, but destroy the resource and eliminate the possibility for any profits in the long run. Here's an image from the International Integrated Reporting Council that shows how these 6 capitals relate to a company's output. The purpose of looking at these 6 capitals and how they relate to the company's business model is to see if the company's being a good steward of its resources as it creates value. So you might be wondering, how are integrated reports any different from sustainability reports, aka corporate social responsibility reports? Well, a sustainability report is a standalone report that focuses on non-financial disclosures. Sustainability reports are disconnected from a company's financial statements and financial reporting, and they've been criticized as being more of a marketing tool. Integrated reporting, on the other hand, combines both financial and non-financial disclosures. An integrated report connects a company's sustainability practices to its financial results and to its long-term strategy for creating value. You might also be wondering whether an integrated report is a standalone report. That depends. A company really has three options. Option 1 is to alter the company's required regulatory filing so that it's compliant with the international framework, in which case the company would just file a single report. Option 2 is for a company to issue its required regulatory filing and to issue a separate integrated report. Option 3 is to issue 3 reports: the required regulatory report, the integrated report, and a corporate social responsibility report. So now that we've talked about what integrated reports are, what are the benefits of integrated reporting? Well, integrated reporting should reduce short-term thinking, allow investors to better assess a company's risks, increase engagement with shareholders and stakeholders, encourage companies to think holistically about their strategy and plans, particularly when it comes to issues like climate change, and improve decision-making by connecting financial and non-financial performance. All of these benefits are really connected, though, as the purpose of integrated reporting is to improve resource allocation and ensure sustainable value creation. This should not only be good for the company's investors, but for society as a whole. But these benefits don't come without some costs. These include the cost of collecting and analyzing data, implementing new processes and control systems, paying a third party for assurance services, and disclosing proprietary or competitive information. So who issues integrated reports? The International Integrated Reporting Council said that more than 2,500 organizations throughout 75 countries use integrated reporting. The only country I could find that actually requires integrated reporting is South Africa. Here's an excerpt from an integrated report issued by Eskom, a state-owned electricity utility in South Africa. Note that Eskom discusses its value creation process and stakeholder engagement. And while the report discusses Eskom's impact on the environment and its community, it also shows Eskom's financial statements. All 6 capitals are discussed in the report. If you're curious, Eskom chose the option where it issued 3 reports: the standard filing with its financial statements, an integrated report which combines its financial and non-financial disclosures, and a corporate social responsibility report. I've included a link to Eskom's integrated report in the description section below. Going forward, it's difficult to say what the role of integrated reporting will be. Will integrated reports be required under IFRS? And if so, will companies be required to hire an independent third party to provide assurance for those reports? The International Sustainability Standards Board has set out to issue a comprehensive set of sustainability standards. So hopefully this will provide more reliability and comparability when it comes to this type of reporting.